Retained earnings, startup versus established company. The concept of retained earnings is explored in this video. The differences in how retained earnings are used in startup companies compared to established companies are explained. What are retained earnings? Start with a relatable example. Imagine you're a small business owner selling homemade cookies. You make $100 in sales, but your costs are $50. The remaining $50 is your profit, but you decide to reinvest it back into your business to buy more ingredients or upgrade your equipment. This is the essence of retained earnings, a company's profits that are kept and reinvested for growth rather than being distributed as dividends to shareholders. Explain the formula. Retained earnings are calculated as the previous year's retained earnings plus the current year's net income minus any dividends paid. It's a simple yet crucial concept in accounting. Dive deeper. Discuss the role of retained earnings in the balance sheet, showing viewers how it reflects a company's financial health and its ability to fund future ventures. Startup companies. Case study. Take the example of a recent successful tech startup like Shopify. Highlight their initial years of heavy investment in product development, marketing, and talent acquisition. Discuss how they use retained earnings to achieve rapid growth and eventually become a publicly traded company. Focus on the lack of dividends. Explain that early-stage startups prioritize growth and reinvesting profits to achieve profitability over paying dividends. This is a key difference from established companies. Retained earnings for survival. Emphasize the importance of retained earnings in startups for navigating difficult times. Case study. A startup like Uber struggled in its early years, but used retained earnings to stay afloat and eventually conquer the ride-sharing market. Established companies. Case study. Analyze a mature company like Apple. Explain how they use retained earnings to fund research and development for innovative products, acquire promising companies, and expand their global operations. Share buybacks. Show how established companies sometimes use retained earnings for share buybacks, which increase shareholder value by reducing the number of outstanding shares. Dividends. Explain that established companies can afford to pay dividends to shareholders while still reinvesting in growth. This highlights their financial stability and confidence. Examples of retained earnings in action. Publicly traded companies. Choose examples from different industries like Amazon, Google, and Coca-Cola. Analyze their financial statements and discuss their significant retained earnings figures and how these relate to their strategic investments and growth initiatives. Practical implications. Explain how investors and stakeholders use retained earnings data to assess a company's prospects and potential for generating long-term value. Key takeaways. Summarize the differences. Emphasize that while both startups and established companies use retained earnings, their priorities and approaches differ. Startups prioritize growth and survival, while established companies can focus on diversification, acquisitions, and shareholder value. Understanding retained earnings is essential. Explain how comprehending retained earnings can provide valuable insights into a company's financial health, growth strategy, and future potential. Future-proof businesses. Conclude by emphasizing the role of retained earnings in building strong and sustainable businesses. Highlight the importance of reinvesting profits wisely to fuel future growth and success. AI-generated content can differ in quality and may contain inaccuracies or inappropriate material. Use caution before creating or using any provided content. This is not professional advice. Thank you for watching our channel this far. We look forward to seeing you in our next video. Please like, subscribe, and share.